All right, welcome to Accounting 102. We are going to start Accounting 102 by looking at corporations. When we look at corporations, there are some things that we need to make sure that we realize because we are switching gears. We've been dealing with, throughout Accounting 101, you've dealt with sole proprietorships and the capital account and things like that. When we get into this information, we are looking at the corporations. With the corporations, we have to realize that they are a separate and distinct entity. They are separate from the owners. It is distinct from the owners. Before we dealt with partnerships, corporations, where the owners would be binding to what they do as far as the corporation is concerned. In a corporation, however, we have shareholders that serve as the owners, and simply being an owner of a corporation does not give you the right to make decisions for that corporation. The other thing that we look at is that the shareholders or stockholders have limited liability. Therefore, the creditors only have recourse against those corporate assets, and they can't go against anything that the owners may have. Other items we see with a corporation are these transferability of ownership. When we dealt with partnerships or we deal with sole proprietorships, if something happens to the owner, then they're pretty much that company is over and a new company has to start. With a corporation, owners actually can transfer their ownership to other people through selling of stock. So, what'll happen with this corporation is this corporation has a continuous life, which means it will go on and on and on and on, pretty much forever until they decide to close it down. Other items that we have are corporations lots of times have a good bit of government regulation, more so than you have with a sole proprietorship. And then we also have additional taxes. Since they are a separate legal entity, then the corporation would be taxed, and then the individual would be taxed on any of those dividends, and so the same money is actually being taxed twice. When we look at these pieces of information, what we find is that there are some benefits and advantages of being a corporation, but there are also some disadvantages or drawbacks. Some advantages are the separate legal existence, the limited liability, the transferability of ownership rights, the ability to acquire capital. You can sell stock to get money in, continuous life, as well as the corporate management. So you would have professional managers for the corporation. Some of the disadvantages could be the separation of ownership and management. So sometimes what the owners want may not be going into play. You have government regulations, and then again, you're going to pay additional taxes. When we look at actually forming a corporation, corporations are formed through the state. Some states have articles of incorporation that have to be filled out and filed with the individual states. Some states are easier to incorporate in than other states are. And you'll see, like, Delaware has a lot of companies that, especially in the banking industry, that incorporate in Delaware because it's very easy to incorporate there. You are issued a charter generally when you do form a corporation, so you'll get that paperwork back from the state, and it has different things listed in it for your corporation. After you get that charter back, you do have to form bylaws. These are the internal rules and procedures about how the corporation is going to conduct its affairs. if you decide to operate in different states, then you have to obtain a license for each state that you decide to do business in. Your home state, you are considered a domestic corporation. So if I incorporate in the state of South Carolina, I am considered a domestic organization in the state of South Carolina. If I decide to go over to Georgia, then I would actually have to file as a foreign corporation in the state of Georgia because I did not incorporate in the state of Georgia. So the domestic and foreign deals with states. Your domestic, again, is the state in which you incorporate in, and the foreign would be other states that you go into that you want to work in. Whenever you incorporate a business, there are costs associated with the formation of, a corporation. These are known as organizational costs, and we will be looking at these items. Other things we look at as far as corporations go, we've talked about it a little bit, is that a stockholder or a shareholder is the person that owns the corporation. You could have one shareholder, or you could have thousands and thousands and thousands of shareholders that actually own the actual corporation. Now, what rights do these stockholders, shareholders have? Well, they have voting rights. So they can come in, and once a year a meeting is held, and they can vote in the election as far as who the board of directors will be at the annual meeting. They can also vote on actions that require stockholder approval. They also have the ability to share in earnings. So they can receive dividends from the company, and that is a return on their investment as far as the earnings of the company goes. They also have the right, and it's called a preemptive right, to keep the same percentage of ownership. So if the company decides to issue new shares out to the public, they have to offer those shares to the individuals that already own shares first, so that that individual can decide if they choose to keep that same percentage or not. And then the last thing they have is this residual claim. If the company decides to liquidate, this certain portion has to go to the stockholders. So what we do, we sell the assets, we pay off all of our creditors, and then the stockholders get the remaining amount, and that would be that residual claim. When we look at stock and shares, some key words and things that we have to look at here, we have a couple of different things. We can say there are a certain number of shares that have been authorized. This means that this is the total amount of shares that the corporation can issue. It has to be stated in that charter. So if it's 100,000 shares, then that's the amount of shares that you can actually issue. Now we come to issued stock. Issued stock are those stock that have been sold or have been issued to the stockholders. So I could have 100,000 shares authorized, but I may have only issued 10,000 shares. So it's going to be generally a lower than what has been authorized in number. And then I have the outstanding shares. These are the actual shares that are in the market right now. So this would be our issued shares minus anything that we've retired or anything that we have bought back in the form of treasury stock would be the outstanding. So our outstanding shares can be equal to our issued shares, but it also can be less than our issued shares. Other terms we're looking at deals with money, market price. This is what the shares are currently going for. This is what they're being sold for, what you can get for them. If it's a publicly held company, that means that it is being traded on a stock exchange, and that market price is whatever price it's being sold for on that stock exchange. If it's a privately held company, then It's not being traded on a stock exchange, and it really is just an agreed upon price between two people. And a privately held company is they do not have a lot of shareholders. They have very, very few shareholders, and again, it's more of a family or small group of people thing for a privately held company. Other terminology is par value. Par value is a value that has been assigned to shares through the charter. It's also known as the legal capital of the company. There are some states that require a company to have legal capital set aside as a reserve amount. Other states do not require this legal capital. But that's kind of where the par value came from, is because there were certain states that required you to have a certain amount set aside. We also have stated value. Stated value comes into play if we have stock where no par value has been assigned through a charter. Then a company can decide that, hey, we're going to put $1 or $2 stated value on this, and they move that over to the side. You also have just plain no par value stock, and this everything goes into the common stock. There is no separation for no par value stock that's out there. The other thing we look at is the owner's equity section that we've talked about in Accounting 101. In Accounting 102, it's shareholders' equity. And what we look at is we have paid-in capital, and then we will have our retained earnings. These are the two sections of shareholders' equity that we will be looking at. As far as paid-in capital goes, it can be broken down into common stock, and it may just be common stock. If you have a very, very simple company, maybe all you have in your paid-in capital section is the common stock. Then you could have paid-in capital in excess of par for your common stock. You could have preferred stock. You could have paid-in capital for your preferred stock, and you can also have paid-in capital for your treasury stock. These are items that are in that paid-in capital section. For your retained earnings, it is going to be made up of things like net income, net loss, and any dividends that you pay out. Now, dividends is similar to what we had in Accounting 101 when we talked about the drawing account. So it kind of does stay the same in that we do have D for drawing, D for dividends, to kind of help you out with looking at the pieces of information. The other thing that we're going to talk about as far as terminology is concerned in this chapter is treasury stock. Now, with treasury stock, this is where corporations own stocks, been issued, been bought back by the company. However, it has not been retired. So it has just been really been issued, and then it's been bought back. Now, there are several different reasons why we might do this. And some of those reasons as to why we might have this treasury stock, it could be to reissue the shares to officers and employees under a bonus or stock compensation plan, so we can buy them back from other people, and then we can issue those out to shareholders, officers and employees, to increase trading of the company's stock in the securities market. Companies expect buying their own stock will signal that management believes that the stock is underpriced. They hope it will increase the market price. And if you think about supply and demand and economics, if there is less of something out there and there's not a big supply of it, then that price is going to increase. So if we purchase our stock and we take it out of the marketplace, then what happens is there is less of a supply, which means that market price should raise. Other reasons are to have additional shares available for use in the acquisition of other companies, and then to reduce the number of shares outstanding. and thereby increase earnings per share. Some companies actually will buy back their stock if they're scared that someone's going to try to do a hostile takeover of the company. Then they will purchase some shares back so that other people cannot purchase these shares and do a hostile takeover. So those are some of the things that we look at in this chapter. The next thing that I really want to look at is how we display that stockholders' equity section of the balance sheet. What we're going to look at with the stockholders' equity section is we are going to have a paid-in capital section. Now, with the paid-in capital section, we are going to list out the capital stock. So we will have the common stock listed. We will have preferred stock listed. We would total those amounts. So we would add these two numbers together and come up with a total for that paid-in capital for capital stock section. Then we have our additional paid-in capital account. This would be items paid-in capital in excess of par for common stock, paid-in capital in excess of par for preferred stock. We could have paid-in capital from treasury stock. We would then add all of these amounts together and come up with a total for that. We then would have our retained earnings number put in, and then we could add all of those numbers together, and that would give us our total for our stockholders' equity section of our balance sheet.